The market has a talent for making simple things look mysterious. That is one of the oldest tricks in finance. A company sells a product. It earns money, its earnings grow, or they do not. It sends some of that money back to owners, or it keeps it. And then the market places a price on that stream of economics. That is the whole game. But if you listen to enough commentators, analysts, newsletters, and traders performing intelligence for one another, you would think investing was a maze designed only for people with 7 monitors and a permanent headache. I have never believed that. I have believed for a long time that the best investing ideas are often painfully simple, and the difficulty is not understanding them once. The difficulty is trusting them long enough to use them well. That is why I want to talk plainly about valuation. Not in the way Wall Street usually talks about valuation, where every sentence sounds like it came from a committee trying to impress a pension board. I want to talk about valuation the way an owner should talk about it. If I were buying the whole business, what am I paying for what I get? How fast is that thing improving? And am I being compensated while I wait? That is really what all of this comes down to. A lot of people make the same early mistake in investing. They think the hardest part is finding a good company. That is not always the hardest part. The harder part is deciding whether the price already assumes all the goodness in advance. A wonderful business bought at a foolish price can still be a foolish investment. An ordinary business bought at a sufficiently low price can sometimes produce a respectable result. Price matters, growth matters, cash generation matters, and the relationship between those things matters even more than the things themselves. That is where investors get lost. They look at a stock with a low price to earnings ratio and conclude it must be cheap. Or they look at a stock with a high price to earnings ratio and conclude it must be expensive. I understand why people do that. The PE ratio is one of the first numbers everyone learns. It feels clean, it feels mathematical. It gives people the pleasant sensation that they are dealing in facts rather than guesswork. But a single number without context can become a very polished form of ignorance. I learned long ago that a stock can look cheap and still be a trap. It can also look expensive and still be a bargain. That sounds contradictory until you understand what the PE ratio is actually saying and what it is not saying. A PE ratio is simply the stock price divided by earnings per share. If a stock trades at $30 and earns $3 per share, the PE ratio is 10. That means you are paying $10 for each dollar of annual earnings. Nothing mysterious there. It is a useful starting point because it tells you how much optimism or caution may already be embedded in the price. A low PE can suggest modest expectations, distress, neglect, or genuine cheapness. A high PE can suggest excitement, quality, expected growth, or simply overenthusiasm. The number alone does not tell you which one you are looking at. That is the first lesson many investors never fully absorb. A PE ratio is not a verdict. It is an invitation to ask better questions. I think of PE as the front door, not the whole house. If I see a company trading at 10 times earnings, I am not ready to celebrate. I am ready to investigate. Why is it so low? Is the business shrinking? Is management weak? Is the balance sheet ugly? Is the industry deteriorating? Has the market overreacted? Or is it simply a neglected business with sound economics that nobody is bothering to appreciate properly? A low PE can be an opening. It can also be a warning label. Likewise, if I see a company trading at 30 times earnings, I am not ready to condemn it. I want to know why. Is the business compounding earnings at a rate that justifies the premium? Does it have an unusual economic moat? Is management excellent? Are margins unusually durable? Does it deserve to be priced differently from the average company because it is not an average company? These are the questions that separate ownership thinking from superficial number collecting. I have watched plenty of people hurt themselves by worshiping low PE stocks. They thought they were buying value. Very often they were buying stagnation. They bought businesses with weak economics simply because the market had already punished them, and they mistook punishment for opportunity. That is a common error. A stock can be down for a good reason. A company can be cheap because it deserves to be cheap. If earnings are falling, if debt is rising, if the product has lost relevance, if management is poor, then the low multiple is not necessarily a bargain. It may be the market saying something unpleasant but correct. On the other side, I have also seen investors reject outstanding businesses because the PE looked too high in isolation. They treated valuation as if one number carried the entire truth. That is too primitive. A business growing earnings at a very high rate can justify a higher multiple than a business whose profits sit still like a tired cow in a muddy field. The market is not only paying for current earnings, it is paying for what those earnings are likely to become. This is where the second layer of valuation becomes essential. You must connect price not only to current earnings, but to the growth of those earnings. That is where Peter Lynch offered the public one of the most useful simplifications in the whole field. Now, I was never in the business of copying Peter Lynch, and he was never in the business of copying me. That is fine. A sound idea does not need tribal ownership. It needs to be true. And what Lynch helped popularize is a wonderfully practical bridge between price and growth, the PEG ratio, price to earnings to growth. Once you understand it, a lot of valuation mistakes become harder to make. Not impossible, because no metric can make foolishness impossible, but harder. The PEG ratio takes the PE ratio and divides it by the company's earnings growth rate. So if a business trades at a PE of 30 and is growing earnings at 30% a year, the PEG ratio is 1. If another business trades at a P of 10 but grows earnings at only 5% a year, the PEG ratio is 2. Notice what just happened. The company that looked cheaper by ordinary PE standards no longer looks cheaper once growth enters the conversation. That is important. It means price without growth is incomplete, just as growth without price is dangerous. A great business can be ruined as an investment if you pay too much. A mediocre business can remain mediocre even when the multiple looks low. The PEG ratio tries to correct one of the most common mental errors investors make. It asks whether the growth rate is sufficient to justify the earnings multiple. That is a very intelligent question. In the Lynch way of thinking, a PEG ratio around 1 suggests the stock may be fairly valued, below 1 suggests it may be undervalued, and above 1 suggests it may be expensive relative to its growth. I like the elegance of that, not because it is perfect, but because it forces the right conversation. Instead of asking only whether the PE is high or low, you ask whether the PE is high or low relative to what the business is actually doing. That is a much more mature frame, and maturity in investing usually looks like learning to compare one thing to the thing that truly matters, not to the thing that feels easiest to measure. Still, if you stop there, you leave money on the table intellectually. Because there is another element that matters to an owner. Cash paid back to shareholders while they wait. This is where the conversation gets better. A company can grow earnings, yes, but if it also pays a dividend, then the owner is not relying only on future growth for his return. He is being paid along the way. That matters. It matters financially, and it matters psychologically. People love to treat dividends as old-fashioned, as though receiving cash from the business while you own it were somehow less modern than staring at unrealized gains on a screen. That attitude is nonsense. Cash paid to owners is a real component of return. It is a sign of earnings quality in many cases. It reflects the company's willingness and ability to distribute part of what it earns. And if you are disciplined enough to reinvest it, those dividends become part of the compounding engine. So when you combine price, earnings growth, and dividend yield, you get a fuller picture of value than PE or PEG alone can offer. That fuller picture is often called the PEGY ratio. You take the PE ratio and divide it by the sum of the earnings growth rate and the dividend yield. That small adjustment matters more than it looks like it should. Suppose you have two companies with identical PE ratios and identical earnings growth rates. If one pays a meaningful dividend and the other pays nothing, they are not equally attractive from the owner's perspective. One is sending cash back while you hold it. The other is asking you to trust management to retain everything wisely. Sometimes retaining everything is exactly right. At other times, dividends are an important part of the total return picture. The PEGY ratio acknowledges that, and I admire that because the market often pretends two businesses are identical when the shareholder experience is plainly different. A company growing earnings at 10% and paying a 4% dividend is not the same economic animal as a company growing earnings at 10% and paying nothing. Both may be fine, but the valuation should reflect the difference. That is the brilliance of bringing dividend yield into the equation. You stop viewing growth as the only reward for patience. You start valuing cash in hand as well. I like that because it resembles how an owner would naturally think. If I buy a business, I care about what it earns, I care about how fast those earnings grow, and I care whether some of that cash comes back to me while I wait. That is not a theoretical exercise. That is business ownership. Now let me say something crucial before people run off and start screening the market like children in a candy store. No ratio can save you from stupidity if you use it as a substitute for thinking. This is where people always try to turn a tool into a religion. They discover a ratio, feel smarter than they felt yesterday, and suddenly want to behave as though they can reduce investing to a spreadsheet and a pulse. That is how trouble begins. A PE ratio can help. A PEG ratio can help. A PEGY ratio can help. None of them can tell you whether management is honest. None of them can tell you whether the balance sheet is fragile. None of them can tell you whether the company's moat is weakening, whether the industry is changing, whether the growth rate is reliable, or whether a recent burst of earnings is a temporary sugar high rather than a durable trend. Numbers are wonderful servants and terrible masters. You still have to understand the business. You still have to ask how the company actually makes money. You still have to ask whether that money is likely to keep coming. You still have to ask whether the return on capital is respectable, whether debt is manageable, and whether the whole enterprise has a real reason to exist 5 or 10 years from now. Ratios do not remove that responsibility. They simply make the first stage of filtering more intelligent. That is how I would use them, not as final answers. As disciplined first questions. Take a company selling at a PE of 30. The amateur mind says expensive. The better mind says maybe. Then you look at growth. If earnings are compounding at 30% a year and the business has a real moat, perhaps the multiple is not unreasonable. Then you ask whether the growth is genuine, whether margins are durable, whether the balance sheet is sensible, whether management is allocating capital intelligently, and whether there are signs that the current growth is masking fragility. Now, take a company trading at a PE of 10. The amateur mind says cheap. The better mind says maybe. Then you look at debt and discover leverage that makes you uncomfortable. Then you look at the industry and find no real tailwind. Then you look at capital allocation and see mediocrity. The low PE was not a secret bargain. It was the market's indifferent shrug toward a second-rate business. That is a very different situation. This is why I keep returning to the same basic philosophy. Buy understandable businesses at sensible prices and hold them long enough for their economics to do the work. Valuation metrics help you decide what sensible means. They do not eliminate the need for judgment. Judgment is still the scarce asset. A man can own the finest calculator in the world and still behave like a fool. In fact, calculators have probably helped many fools sound more confident than they deserve. Confidence is cheap. Correctness is expensive. I would rather be approximately right about a strong business than precisely wrong about a weak one. That has been one of the most useful ideas in my life. Now, because I know how human beings behave, let me tell you where these ratios help emotionally, not just mathematically. They slow you down. That is a gift. A lot of money is lost because investors do not slow down enough between excitement and action. A stock starts moving. A story gets popular. An article makes a company sound like the future of civilization. The chart looks irresistible. And because the investor feels urgency, he buys before asking the only questions that matter. What am I paying? What am I getting? How fast is it growing? Do I receive cash back while I wait? Do I understand the business? Can I explain why this should be worth more later without sounding like a preacher? PEG and PEGY framework does not answer everything, but it forces a pause, and the pause can save you a fortune. It can stop you from buying glamour at an absurd price. It can stop you from buying a broken company just because the multiple looks low. It can stop you from treating yield as a free lunch. It can stop you from confusing a popular stock with a good investment. That is useful. Very useful. I remember periods when the market was paying breathtaking multiples for companies simply because their story was fashionable. If you had looked at valuation only through the eyes of current excitement, you would have concluded that those prices must be justified because everyone intelligent seemed to agree. Crowds do not make arithmetic less real. A PE ratio far above what growth can support is still dangerous, even if the whole market wants to sing about it. Likewise, in ugly periods, the market sometimes throws away solid businesses because fear is easier than discrimination. That is where these ratios can become genuinely helpful. If the business remains healthy, if growth prospects are still there, if dividends remain sound, and the valuation has compressed below what the economics suggest is reasonable, then the crowd may be handing you an opportunity wrapped in pessimism. This is one reason I like simple metrics so much. In periods of mania, they can protect you from joining the party too late. In periods of fear, they can help you notice that a good business has been marked down more aggressively than its real prospects deserve. That is intelligent valuation. Now, there is one more thing I want to say because younger investors often miss it. You do not have to become a stock picker simply because you understand valuation. That would be another mistake. A lot of people learn just enough to become dangerous. They understand P, PEG, and PEGY, and then immediately assume they can go hunting through the market and emerge with a basket of hidden masterpieces. Maybe they can. More often they will underestimate how hard it is to judge business quality consistently across many industries. I have no objection to learning valuation deeply. I do object to people overestimating what that learning entitles them to do. For many individuals, broad low-cost index investing remains the sound core. It is perfectly respectable to understand stock valuation deeply and still decide that the majority of your capital belongs in broad productive ownership. That is not intellectual surrender. That is discipline. You can use valuation tools on individual companies you truly understand. You can build a watch list. You can occasionally act when a business you know well becomes obviously attractive, but you do not need to transform every lesson into a new compulsion. Most fortunes are not lost because people lacked ideas. They are lost because people felt compelled to act on too many of them. I like restraint. Restraint leaves room for the good decisions to matter. Let me show you how I would mentally use these metrics if I were evaluating a company today. I begin with the business itself. Can I explain in ordinary English what it does, why customers pay for it, what the moat is, if any, and whether those economics seem likely to persist? Then I look at earnings. Are they real? Are they lumpy? Are they cyclical? Are they inflated by one-time conditions? Then I look at the PE ratio. What is the market charging me for those earnings? Then I look at growth. Not just one loud recent quarter, a pattern. What has happened over several years? What seems durable? What seems temporary? Then I consider dividends. Does this business pay one? Is it well covered? Does it matter to the total return? That takes me naturally toward PEG and PEGY. Not because those numbers are magic, but because they force me to compare the price I pay with the economic movement I receive. That comparison is the essence of intelligent investing. You are always making a trade. Capital today for economics tomorrow. The question is whether the trade is sensible. Now, let us talk about one of the most dangerous habits in investing. People love a single threshold. Below 1 is good, above 1 is bad, below 15 is cheap, above 30 is expensive. The human mind loves simple categories because categories make life feel manageable. Markets do not care about your love for simplicity. A peg below 1 can still hide fragility. A peg above 1 can still be fine if the business quality is exceptional and the growth is more durable than the market understands. A low PE can still be a trap. A higher PE can still be justified. What matters is context. The ratios are not judges. They are interpreters. They help you translate price into business terms, but they do not absolve you from thinking. This is where I see people get lazy. They want ratios to replace reading. They want screening to replace understanding. They want formulas to relieve them of the burden of judgment. That is not how this works. If you are not willing to study the company, the competitive landscape, the margins, the capital allocation, and the balance sheet, then you are probably better off staying mostly in index funds and living a happier life. There is no shame in that. The market is not a classroom where everyone gets extra credit for complexity. Now, I want to bring up Peter Lynch for a moment, because the public often remembers the legend and forgets the method. Lynch was not merely a man with a ratio, he was a man with a way of thinking. He looked for understandable businesses, growth at reasonable prices, and plain evidence that the market had not fully recognized the value in front of it. That is why the PEGY idea resonated so strongly. It was not about cleverness for its own sake. It was about avoiding the stupidity of separating price from growth. That is an important distinction. A great ratio is not great because it sounds smart. It is great because it corrects a common error. The common error here is very human. People look at price and freeze growth out of the conversation. Or they look at growth and freeze price out of the conversation. The PEG and PEGY ratios that is why they are useful. Still, even a useful ratio can be abused when it flatters the user's desire to believe he has found certainty. Certainty is rarely available in investing. You are always working with partial information and probabilistic judgment. That is why temperament matters as much as math. You can run all the screens in the world and still lose money if you cannot hold sound ideas through inevitable discomfort. The man who buys a reasonable stock at a reasonable valuation and then sells because the market declines has not been saved by his spreadsheet. He has been defeated by his own nerves. That is why I keep saying ownership thinking matters. A real owner does not ask every week whether he should sell the whole farm because commodity prices had a rough month. A real owner studies the economics, the weather, the debt, the yields, and the long-term prospects. He may well decide to sell at some point, but not because the ticker frightened him on a Tuesday afternoon. This is the right posture for stocks too. A stock is not a magic symbol, it is a fractional ownership claim. The market wants you to forget that, because ownership thinking is calmer than speculation, and calm people do less stupid activity. That is bad for a lot of businesses built on your nervousness. So I would use PE, PEG, and PEGY not only as valuation tools, but as reminders of what I am actually doing. I am buying earnings, I am buying growth, I am sometimes buying dividends. I am not buying excitement. I am not buying a story because it flatters me. I am not buying noise because noise is moving faster than truth. I want price, business quality, growth, and shareholder economics to line up well enough that I can sleep while I own it. That is a high standard. It should be. Sleep is underrated in investing. Now let me warn you about another trap. The PEG ratio is particularly vulnerable to bad inputs. If the growth rate you use is fantasy, then the ratio becomes nonsense with a confident face. This matters a lot. A company can show explosive short-term earnings growth because of a temporary margin surge, one exceptional product cycle, cost cuts that cannot be repeated, or easy comparisons to a weak prior year. If you feed that temporary growth into the PEG formula as though it were durable, the stock will look cheaper than it really is. That is dangerous. Same with dividends. A yield may look attractive, but if the payout is stretched or the balance sheet is deteriorating, then the dividend can be cut. If you treat the yield as secure when it is not, the PEGY ratio will flatter the stock more than it deserves. That is why quality of inputs matters so much. Bad arithmetic with good-looking formulas is still bad arithmetic. You must think like an adult about the numbers. Where did the growth come from? How repeatable is it? What happened over a full cycle? What happens if margins normalize? What happens if the dividend is not as secure as it appears? These are the questions that separate a user of ratios from a prisoner of ratios. I prefer users. Prisoners are easy to fool. Now I want to shift to a more personal point. The reason I like valuation so much is not because I am obsessed with cheapness for its own sake. Cheapness alone has never interested me much. I am interested in the relationship between what I pay and what I receive. That is true in stocks. It is true in businesses. It is true in life. A bargain is not something with a low sticker. A bargain is something whose future economics exceed the price you pay. That is a much more mature way to think. Many people never learn that, and they spend their lives buying low-quality things at low prices and calling themselves prudent. That is not prudence. That is confusion. The market offers the same confusion in more sophisticated clothing. A low multiple on a weak company is not automatically value. A higher multiple on a strong company is not automatically excess. You have to do the work. That phrase is overused, but here it applies cleanly. You have to do the work. Understand the business. Understand the price. Understand the growth. Understand the yield, if there is one. Understand the durability of all of it. Then compare. Then decide. Not the other way around. I think one of the great advantages ordinary investors can build is simply learning to ask better first questions than the crowd asks. The crowd asks, is it going up? Is it popular? Is it cheap on PE? Is it paying a big dividend? Those are not useless questions. They are incomplete questions. The better questions are harder and calmer. What am I paying for normalized earnings? How fast are those earnings likely to grow over a sensible period? Is some of that return arriving as cash in my hand? How reliable are the inputs I am using? And most importantly, would I still feel comfortable owning this if the market stopped flattering me for a while? That final question matters more than almost any number, because numbers do not hold positions. People do. The stock market is littered with technically smart ideas abandoned by emotionally unstable owners. I have always tried to reduce the number of decisions that depend on future courage. That is why I like understandable businesses at understandable prices. And that is why I respect valuation tools that simplify the right things. The right simplification is powerful. The wrong simplification is dangerous. PE, PEG, and PEGY are the right kind when used wisely. They do not promise certainty. They improve perspective. That is enough. If you gave me only a few minutes to explain intelligent stock valuation to a new investor, I would say this. Start with earnings. Ask what price you are paying for them. Then ask how fast those earnings are likely to grow. Then ask whether you receive cash back while you wait. Then ask whether the business itself deserves your trust. That sequence will save you from a lot of nonsense. And the longer you invest, the more you realize that avoiding nonsense is half the game. You do not have to catch every winner. You do not have to predict every cycle. You do not have to sound brilliant at dinner. You do have to avoid paying stupid prices for mediocre economics. You do have to avoid calling a low multiple a bargain when it is really a warning. You do have to avoid acting as though growth excuses any price at all. And you do have to avoid forgetting that dividends are part of return when they are real, durable, and intelligently paid. That is a sound foundation. It will not make you famous. It might make you richer than most people who spend their lives sounding more sophisticated than they are. That is good enough for me at my age. I value methods that still make sense when the excitement is gone. Valuation is one of those things. It strips away storytelling. It asks what you pay and what you get. That is, the market is often dishonest in mood, but the underlying economics are stubbornly honest over time. If you anchor yourself there, you improve your odds. Not because the future becomes certain, because your framework becomes less foolish. That is a wonderful upgrade for any investor. And if you can combine that framework with patience, restraint, and the humility to admit that no single ratio tells the whole story, then you are already behaving better than a great many people with louder opinions. I like those odds. They are the kind of odds that built my life, not dramatic odds, not thrilling odds, sensible odds, and sensible odds, handled with discipline, are more than enough.